Hi, welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and this is our weekend question and answer where I try to answer some questions sent in by some of my readers. So let's get started. First question comes in from Paul, and Paul writes, I'm attempting to learn how to read the tape, and I've noticed a peculiar phenomenon. When a big offer comes in and gets taken out, the price goes up, and conversely, for the bid, if a big bid is in and it gets taken out, the price drops further. That is somewhat confusing to me because I was thinking that if a big sell lot came in, the price should drop, but instead they get filled, the price goes up. Can you just very briefly explain this? Well, this question caught my eye because this takes me back to like one of my first months on the floor when I first started to learn this business. And you first went down it, you don't know anything, and in this business there's no university that teaches you the workings of the market. Okay, it's all on the job training. You've got to get your foot in the door, and then you start learning by your mistakes, or you might have a mentor, or in my case I had other clerks and employees of the firm that were going to help me along, and the learning process took quite a while. But the first lesson I learned was one of the other clerks that had been there quite a while. Well, to me it was quite a while, but later on this guy became my partner. So he comes to me with the specialist book. Back then it was a paper book, now it's electronic, but basically set up the same way. And all the orders that were entrusted to the specialist were actually entered into this book by pencil and paper. And there were two kinds of orders. There were day orders that were not executed during the day. They were taken off the book and for the next day, and there were GTC orders, which were actually orders that were good till canceled, and either they got canceled or they got executed. So these orders would build up on our book over a period of time. So the book would take on its own look. So he comes to me with this book. This is one of the first lessons I learned. And he shows me this book, and there's nothing but sell orders from 25 all the way up to 32. Almost at every price, someone's got an order in there willing to sell. And then I look at the buy side, and there's like hardly any buy orders whatsoever. So logic would say, look at all these sellers, this stock wants to go down, because there's just no buy orders in this book, nothing but sellers. That's what logic would say. So the question was, and knowing a little bit about this guy, and the way he posed the question to me, I got the sense that it was a trick question. He said to me, looking at this book, would you say that this stock wants to go up or wants to go down? So like I said, sensing it was a trick question, I couldn't answer logically. So I said, even though I didn't believe it in my heart, I said, it's an up book. And he said, you're right. So I was like, you got to be kidding me. Please explain to me why. And the only thing he could tell me, and I saw this play out so many times over the years, that he was right about this, that the offers, when you see all these offers there, they're there for one reason. They're there for somebody to come in and buy them. That's what they're there for. So it's almost a game of opposites. It's like it says to me, don't be concerned as to what you can see. Be concerned about what you can't see. Because we can't see the buy orders, but they wind up coming in. And conversely, the downside's the same way. You have a book that's nothing but buyers, all the way down $5, and no sell orders. Chances are, very good chances are, that stock wants to go down. This is one of our little indicators we use as a specialist to help us determine which way we thought the stock was going to go. And it plays out so many times that way. And so I hope that, I don't know if that explains the reason, but it tells you the next time you see it that you have to think, not logically, that if you see a lot of offers, chances are stock wants to go up, and if you see a lot of bids and no buys, chances are stock wants to go down, Paul. And it was a good question because it brought me back all those years, and it was like the first illogical lesson I learned on the floor of the exchange, and it plays out all the time like that. Okay, next question comes in from Jason, and Jason writes, it happens all the time when stocks gap up and gap down. I've been curious about why it happens and the thought process individuals go through that determine the opening price. It has been extremely annoying as of late with the gap downs have been huge and stops are triggered substantially lower than I want them to. Stops are always executed lower than you want them to. That's why they're they're hard to understand stops, and it's one of the main reasons why I personally don't like to use them. But this is two questions, so let's get to the first part of the question. Gaps are caused by disparity between supply and demand at any one given time, usually at the open, usually caused by some sort of corporate news or world news or some kind of news that makes people act emotionally, and they're selling. Market orders, get me out. Then the specialist has to try and price that, because he's probably going to wind up buying most of the stock or a good portion of it, and he's going to buy it as low as he possibly can within the guidelines of the exchange, so he can try and make some money. If you were the specialist, you'd be doing the same exact thing. You got to remember, all those sellers, he didn't tell people to sell. It's his job to try and find buyers for them at that time, and that's what he does. So he tries, if he has to buy them, he's going to buy them as low as he possibly can. Then what happens is, after the initial break, a lot of times the market kicks back, because it's always an emotional response. Okay, sell stops, if you get caught up in this situation and sell stops get initiated also, it just adds to the selling and probably adds to the pressure, and means that the stock will probably even open lower. Okay, but let's say during the day now, let's get to the stop orders, because it's a question that constantly comes up, and it's hard to understand the stop, how they work. People who've been watching me know I don't like using them myself, because I'm a former specialist, and we can almost make a living on, buying these stops, because they're always selling. It's like a panic selling. Everyone wants out at the same time. They seem to accumulate around a certain chart spot, and they accumulate. You think you're the only one out there with your 500 shares for sale at that one price, but there could be 50,000 other shares for sale too, other people. And they get all grouped together, and then they get put on at a discount. The way I like to handle the situation is, when the chart breaks or changes its look, I know the price, because I tell people this is where you should put your stop order, because most of my readers like to use stop orders. And that's fine. It's your money. You can protect yourself any way you want. I'll make the recommendations. In my mind, what I'm saying is, if it breaks this price on a closing basis, I myself don't like the look of the chart. But I'm not necessarily going to put myself in a situation where I'm going to hand the specialist a market order to get me out. I'll ride it down. I'll let that happen. And then on the kickback, as he's selling his stock back out that he bought at the discount, as the kickback happens a couple hours later, or maybe a day or two later, that's when I'm selling out also. So I may not make money on the trade. I may only lose a half a buck, but I'm not going to lose $1.50 or $2.50 by handing him a market order. I did this, so I know how it works. That's why I'm personally against putting sell stop orders down on the floor. Now, there are other ways of protecting yourself. You can say the stock's trading at 25. The sell stop price is 24. You don't know if you're going to get 24. You don't know if you're going to get 20. It all depends at the time when your order gets executed or initiated, because the rule is this. When the stock trades at your limit, wherever your limit is, at or below, your order then becomes a market order. And at that point, you have no idea how low it's going to be. So one way of protecting yourself is you can put a sell stop in at 24 with a 24 limit. In other words, when it trades at 24, if I can sell it at 24, I will, but I don't want to sell it any lower. You can do that. Or you can say, sell stop at 24 with a low limit of 23.5. I don't mind selling it down a half from the last sale, but I don't want to sell it down $1.50. So that's another way of trying to protect yourself. But there's no one surefire, guaranteed way of knowing exactly how to handle each time you need to get out of the stock. Each time is different. There's no one rule fits all here. But like I said, my way of doing is once the chart gets broken, on the next kickback is when I try to get out of the stock. I'm not going to throw the stock out the window. I'll wait for the kickback. And there's risk involved there, because they don't always kick back, but the majority of times they do. Okay, so I hope that's helpful, and I'm running out of time. So until Monday, this is TK signing off.